Good evening and thanks so much for tuning in. This is the ET Money Show on ET Now and my name is Alex Matthew. This show gets you everything that you need to know about your money. How to earn more of it, how to invest and meet all of your financial goals, and also how to spend and get the best bang for your buck because you have to enjoy the fruits of your labor. Now, on today's program, we'll be dealing with some very core aspects about the handling of money, about your relationship with money, and the mistakes that are often made in the earning and spending and investing of money. Let me introduce my guest. We've got Santosh Navlani, COO of ET Money, joining us in the studios. Thank you so much, Santosh, for taking the time.
Thanks, Alex. It's a pleasure to be here.
You know, this is ultimately the business that you're in. You help people manage their money better. What are the learnings that you've had in terms of what people's behavior with money is, what their relationship with money is? Have you figured out what it should be? Because I think a lot of us are dealing with that right now.
Yeah, I guess money is way too emotional, right? People are always emotional about their hard-earned money, and that governs a lot about the relationship with what they do with the money. But as any other relationship, right? Money relationships are all about comfort, reliability, and satisfaction, and money is no different. So, if you're somebody who is comfortable about taking decisions around personal finance, the chances are very high that you'll have a good relationship with your money. If you are somebody who taken decisions in the past and they've turned out to be good as far as finances are concerned, chances are very high you'll be comfortable about talking about your money. And third thing being, if you are somebody who can rely on your money for planned, unplanned indulgences or unplanned emergencies, then the reliability factor gives you a lot of confidence about your future. So I think how I can relate to my money is all about these three factors of comfort, satisfaction, reliability. And if you have all these three, then relationship is beautiful.
Absolutely, and it's incredible to be able to inculcate that. But having said that, I think over the years, Santosh, I've interacted with a lot of people that are frightened of managing money.
Yeah.
They believe that it's a very the requirements to manage money are very high from a knowledge standpoint. You need to be able to track the market on a regular basis in order to do the right thing. Yeah. Do you think that should be the approach, or is it much simpler than that? Can you break things down so that people will be not so afraid of managing their money?
Yeah, I think it's much simpler than what we made out to be, but it is not as intuitive for people to behave that way.
Yeah.
Let me give an example. It's like over the years, when we look at how users use ET Money app, we've learned a lot by observing them. And if I look back how things were in say 2007, 2008. Money was actually not looked upon as it is looked today. It was like money is something which brings anxiety. Too much of money brings stress. Money has always been volatile, so it slips out of hand. So I keep it in a vault. I keep in a bank FD. I probably park that money in a physical asset like real estate or gold, where I can feel that it is safer. Yeah. So what used to happen earlier with money was I will always look for safer avenues about managing my money. But things like 2014, when the government got changed, reform agenda, demonetization, people earning more these days, the IT boom, which has ensured that the salaries actually are such that many people earn their starting salaries such that it is like more than retirement salaries or people or the parents' retirement salaries in that sense. And the more money has brought in a lot of avenues to spend it as well.
Yes.
People have a lot more indulgences, a lot more smart devices to spend money on.
True.
Vacations. Startup boom has always contributed to it as well. And of course, in work from home right now for last 2 years, where people have got time. So how I look at money in last 4 or 5 years has changed, that money identifies what I am. For some people, money has become status. For some people, money stays like more of a liberty. For some people, money stays as something which is as anxious or as volatile as it used to be. But some people, it is something which helps me achieve my progress.
Very true.
So people have kind of changed in how they manage money today. and now that is also reflecting in how they invest their money.
Very true. I was coming to that point because a lot has been said, Santosh, about how things have changed since 2020. You saw that big crash in March of 2020, and I think a lot of people bought that crash. You had a lot of new entrants to the equity markets, and in a sense, they've only seen success.
Yes.
But having said that, would you say, in the kind of insights that you receive, would you say that people have changed the way that they look at the equity markets, for example? They look at investing differently. I know that my own father invested as much as he could in the Provident Fund. He did a VPF because he was risk averse. So do you think that perspective has changed?
It has changed. It has changed a lot. At ET Money, we offer VPF facility, and I don't see anybody actually opting for it. But yeah, that's a different thing altogether. People's perception about risk has changed, right? I think what was 2008 or 2007 when the global financial crisis hit us, and a lot of people sold and lost their shirt, lost their money, hard-earned savings. They became very risk averse. But over the course of last 10 years or so, people have learned a lot by reading a lot of YouTube influencers, media they've been watching, learning by looking at things. And distinctly what is happening since 2014-15, every crash has been bought. People actually been buying the crashes instead of selling in the crashes. Of course, there are people who will be selling as well, but generally you see people are buying the crashes because we run an investment app. We see that healthy behavior, that a market is being down for 3 or 4% in a matter of week, or maybe 10% over a month. You would see the investment transactions going up. So that healthy behavior is coming in today, where people are buying the crash. And what has also helped to the behavior investing outcomes as well is that India has become an SIP country. So when 11,000 crores are coming in via your and mine SIP every month, even if we are not buying, we are buying the crashes. Even if we are not exercising the decision to invest today, if the market is down, people are exhibiting that choice by giving money to the fund manager who is investing via SIPs, and people are buying the crashes again. So that fear of markets always being down, or markets something which is way too volatile, has probably been overcome by a large amount of people today.
Now, the other aspect is, and we were speaking about this before the show, Santosh, which is 5 crore SIP accounts. And if I'm not mistaken, you were mentioning some 3 SIPs per person on an average, right?
Yes.
So there's still incredible scope for growth. But I was also coming to the point of how people react and the behavioral aspect of it, right? You said that is changing, and that is great to hear from you as well, is that people are buying the crashes. But you're generally encouraged to not react to stimuli as quickly as the snap of a finger. You have to be a little bit more patient. But how does one inculcate that? It's human behavior at the end of the day, right?
I think it's more about sticking to a plan, Alex. You know what? So let's look at both the scenarios when something positive happens or something negative happens. When the markets are going up and up and up, as they have been over the last 2 years, if we continue investing the way we have been, like just putting SIPs after SIP every month, without looking at something called as one's asset allocation, that how much money, how much portion of my investable surplus is actually going in equities. If you don't keep an eye on that, it might surprise you. Because if most of my assets are in equities, and there is a sudden turn of events and markets see a sharp drop of say 20% or 25%, as we saw almost 40% in March 2020, then it may not be a happy outcome for you.
And because there are so many moving parts, right? You're talking about how much does one individual investor pay attention? Do you look at the Fed? Do you look at the bond yields in the US? Do you look at the equity markets there?
So I would say one should not overly bother about those things. Look at an asset allocation plan. The fact is, if we look at history, you judge the returns not by how much Nifty or Sensex have given last 20 years. Judge it what is the rolling returns
Yes.
period that people have earned returns over, say, any 5-year period or any 7-year period. And chances are very high that almost 70% or 80% of the times people would have earned returns in excess of 12%.
Right.
Yeah. Now, if in excess of 12% you're earning over 20, 25, 30 years of compounding, everybody can become a crorepati. Yeah. So there is no rush to become one. You can become crorepati end of the day anyways if you stay with a plan of asset allocation. Now, how do you want to look at asset allocation plan? It's like knowing when I need money. So people keep, markets don't keep dates with you. You keep dates with your goals.
Yes.
Right? So if somebody's child is like going to be 18 years of age, the father or the parent has plans for his or her education.
Right.
Yeah. You can't going to postpone the education just because markets decide to fall. So that means when I keep a date with my goals, I would always work towards cutting down the risk in the portfolio by keeping most of my assets in safe zone when my goal date is about to arrive. So if somebody was, for example, in March 2020 and there was a crash and he or she was well planned on his or her own asset allocation plan and ensured most of the assets were in safe zone, be it 40% or 60% crash, his or her money would not have been affected and the goal would not have been affected. So you would not even acted irrationally.
Right.
Yeah. So people act irrationally, which means that I would basically sell in a crash is when I have a goal to keep. When I have a
and
date
you're
to
worried
keep
about the capital that you
Yes,
have
yes.
lost.
And when you're not worried about it, and you have a kind of long-term horizon that I actually have 5 years more to go, you will act differently and you'll probably invest in the crash. So knowing what you're investing for and having a plan at the back of the mind is much more important than tracking markets. What is happening to US, what is happening to Fed, what Fed is doing to markets should not matter a lot.
This is actually something that I think is going to put a lot of things in perspective for a lot of people. I want to speak about asset allocation because I think a lot of misconceptions are prevalent even in that aspect of things, Santosh. And you were talking about the fact that it should be derived by the goals that you have and you should have a date with your goals. But a lot of people get confused in this aspect. So if they say that they have a number of short-term goals, they have a number of long-term goals, do they set aside money in both equity and debt and maintain an asset allocation per goal? Or do they have an overarching portfolio-based asset allocation strategy? And how does one relate one to the other? Is it fixed or does it shift over a period of time?
So I think it's to each his own in that sense. But going by human behavior that we all exhibit in bad times and good times, it's always better to have goal-based portfolios.
Sure.
Yeah. So again, if for example I don't have a goal-based portfolio and I'm managing my entire net worth as one full asset allocation plan, and in that case I wouldn't know whether I should be 60 or 40 when markets crash. Right? At 2020 happens.
Exactly.
Yeah, I wouldn't know how to react to that. I might decide to buy some more, but if you look at if my entire net worth is say 10 lakh rupees or 50 lakh rupees or 1 crore rupees, depending on one's financial situation, even if I decide to buy, I might decide to buy like 5 lakh rupees or 2 lakh rupees or 1 lakh rupees. Now, an entire portfolio of say 10, 50, 1 crore, these are small amounts.
It's and it's an arbitrary number.
It's arbitrary number.
Whatever you feel like at that moment.
Exactly. And it may not impact your average buying cost by huge amount because you've been investing for such a long time.
Yeah.
So, basically, keeping one single portfolio and not bothering about goals may not help. What helps is I have an asset allocation plan for each goal. Say I have my retirement plan, which is say 20 years down the line. I have an educational goal for my children, which is say 12 years down the line.
Yeah.
And I have something, for example,
buying
an SUV. An SUV I'm buying, like a high-end SUV I want to buy in 5 years.
Yeah.
Now, how I really have asset allocation plans for each of these very different, because something which is I require come what may in 5 years from now, a dream SUV I cannot definitely say I want it. I can compromise if the need be.
But your education, your child's education.
But education of my children, I will not compromise on. I will not say, hey, college, that please can you postpone the academic year by 1 year? It's not going to happen, right? No, the fact of life is, for a 12-year goal, I may be able to take more risk. And maybe I will have an asset allocation plan which is geared towards equity, maybe 60, maybe 70, maybe 80.
Sure.
Depends on the what we call is investor personality.
Yeah.
And for something retirement, it is so away that maybe my 80-90% of my assets would be in equity. So if I have that kind of clarity and a market fall happens, I know what percentage has deviated from the asset allocation plan of mine for my children's goal.
Yeah.
By what percentage is deviated? Because if equities fall, the asset allocation will get deviated towards a lower number, and lower number will ensure that debt proportion will show up higher.
Yeah.
Right. So the 20-year goal may be kind of something which may not fall in much, because I am only starting to invest right now in that.
Sure.
But children's education, maybe I'm saving for a long time and I have a sizable corpus there. So the goal-based approach allows you to really be fine-tuned about these things far better and know which goal to add more to in a crash. So do you add in all, or do you add in one?
Just to elucidate what you've said in the examples that you've given, which is just to take the example of the child's education in 12 years, assume that you have the risk-taking capability of saying, okay, it's a long-term goal, it's more than 10 years away, I will have a substantial equity allocation. Yeah. Market crashes by 20%, so your allocation has actually gone to 60.
Yep.
60-40 from 80-20. Yeah. You push it up to 80
again.
Because there's been a substantial deviation.
Yeah.
So there you have it. It's a goal-based approach to your asset allocation strategy, which is something that is very simple to follow. Now, the other aspect, Santosh, is what a lot of people have already called the paradox of choice, which is the number of products that are available to buy in the markets, not just equity mutual funds, but fixed income plans. You're talking about hybrid arbitrage, you name it. You're talking about foreign investments, which are on pause right now. But how does one understand what they need to buy? Because when you're faced with so many options, you won't choose.
Yeah. So I'll take a kind of different approach here. It's like, we always tend to look for the winners of recent past.
Yeah.
Right. It's very hard to convince oneself that the markets have fallen. Last year markets have not been good, but let me still buy an equity fund. I would say markets have fallen and they will fall more, and I will buy a debt that year, where the chances of an equity performing may be better. If a small cap rally has been way too high and they show up top of the charts, I'll end up buying that. I'll be kind of mindful of buying that, which is actually a wrong thing to do.
Recency bias.
Yeah, recency bias, exactly. So recency bias is always at play to select a fund. And when you buy funds, you actually are not doing best thing to yourself, because when you buy a fund, it's a collective mandate that the fund manager is managing. So for example, if you're putting money in large cap fund, now as per SEBI's regulations, a large cap fund is something which always maintains 80% or more assets in large cap stocks. Right. Now, if I am basically investing for my SUV goal, which is going to be in 5 years from now, is large cap the best choice or not? I wouldn't know that. Let me not comment on that today.
True.
But the fact of life is, in 3 years down the line, for example, I started investing in the SUV goal in 2019, and I've passed 3 years to that. I have 2 years more to go. And if markets decide to crash, will I buy more or not? It depends on my asset allocation plan. So you need to basically know your asset allocation plan, which should govern what kind of products you should buy, and not the top best performing fund. So when we go for buying the best fund, the paradox of choice becomes very high. When you say, no, I'm not basically buying the best performing fund, I'm buying a best performing portfolio for myself, then the choice paradox actually reduces. So you need to work towards reducing that.
I want to understand how your platform works, because if I'm not mistaken, there is an advisory aspect to this that helps you plan towards these goals, right? So what would I find if I went onto your platform? If I had, say, for example, a retirement goal, I want to buy a house and I want to educate my kid.
So there are two aspects to ET Money. One is you come on the app, and if you are somebody who's prepared that I need to invest so much for goal A, B, C, I would plan my investment amount. I would basically have a fair idea of what my asset allocation plan should be. And I buy a good fund using, say, something called as ET Money Rank. We have a fund report card for every fund in the market, which we base on two unique aspects of funds: consistency of performance, and second being downside protection. Ultimately, everybody invests for better returns, consistent returns, and lower downside. So we prioritize that. People can choose funds based on that. The second aspect to it, something called as ET Money Genius, where we allow people to basically plan their investments better.
Sure.
And over there, what we do is something unique. We first understand your personality.
Okay.
In the old school way of doing things, which is called risk profiling. So I think investment behaviors are much more nuanced than just understanding risk aspect of it. So we first understand you as a person,
okay,
and build something called as more of a asset allocation plan in the back end. And we recommend you a set of portfolios that you buy and not top performing fund.
Understood.
In fact, we believe that since you're investing for long term, buying index funds is far better choice for your money. Being in passive funds is a far better choice than buying an actively managed fund, because I wouldn't know which fund will be top performing 10 years down the line.
Yeah, because a lot changes in the interim, right? It could be because they play different themes.
They play different themes. They will broadly follow the same strategy. But then the fact of life is the fund manager's job is to outperform the market. And for outperformance, they will deploy some strategies. Sometimes strategies work, sometimes they don't.
Yeah.
What we have seen over long periods of time, like 10 years, 15 years, it evens out, and most people deviate towards the average returns. And the average return chances are very high, will be very similar to what index gives in nation. So why would I bother about buying an active fund? So we believe that if you're building portfolios through ET Money Genius, you should basically buying passively managed funds. So we give you that option of buying a portfolio, which we manage for you in a way that we send you alerts every month that, hey, Alex, this month your asset allocation plan actually should have been this.
Right.
But because of market movements, it has become like this.
Right.
And we also believe that because markets are highly valued or are cheap, at this point of time, we need to make some deviations to the asset allocation plan.
Sure.
You just come and on the app and execute that change, and it happens in one tap. So what we do is, as I was saying, that life is more about keeping in date with your goals and not really bother about markets. We do that hard work for you, and you can just manage in a tap.
That sounds incredible. It's been a pleasure speaking with you, Santosh, and I look forward to our interactions, which I'm sure will be quite regular.
Sure. Pleasure, Alex.
On that note, we're slipping into a short break, but there's more on the other side of this commercial break. Do stay tuned.